Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 15. And as you can see, like I mentioned, I'm actually at the multifamily conference this weekend, and I'm sitting at the Trust Your Talent booth here. We're at booth 211. So if you're here, come and visit, okay? Come and visit us this weekend. Would love to meet you in person, especially if you've been following me and I have not had the chance to speak to you yet. Now, with that said, that's probably also why I'm not quite sure how this is going to turn out volume-wise. So I'm really hoping that everything is going to be clear. Today is season 3, episode 15. And as I mentioned, we're going to continue as part 2 of the top real estate investing priorities. And so yesterday we did manage to cover sorry, did I say top 2? I mean top 6. So yesterday we did manage to cover number 1, number 2, number 3, which now again I'm sharing on the screen with everybody, which is positive cash flow, return on investment, as well as financing and equity. Now, if you recall from the previous episode, financing and equity, it have so much to do with what the lenders, what the banks tell you what you can or cannot do. It is really more about the position that you would like to be in that particular deal. Now, with that said, though, what I would like to continue to share with you is that number 4, what do we want to look at? This is basically one of the biggest, I guess, areas of potential improvements, especially on performance later on. However, these things I want you guys about it. Is it capital expenses? I think that's a term that a lot of us have been learning a lot. Is it capital expense or is it an operational expense? So state of repairs and cost, when you are initially inquiring and acquiring a performing asset, in this case, real estate, as we keep saying, state of repairs and cost need to be obviously factored in. However, is it factored into your day-to-day spreadsheet, or is it factored in when you're initially acquiring the property? And so this has a lot to do with the concept of what are you going to factor in when you're going through the BRRRR process in the beginning. So remember, buy and renovate. So sometimes what I do tend to see people do, though, is that they do not just only renovate, is the fact that they probably confuse what can be done later on. And in accounting terms and for investors, we call those deferred expenses. Now, the way we look at deferred expenses is very different compared to what an amateur would actually do or look at, simply because of the fact that I think so many people, because maybe the property is not performing and they don't have the education or the knowledge or the experience to actually bring it up to speed in terms of the performance level they will like it to have. And so they put off the repairs and the maintenance work that actually needs to be done in order for the building and the asset to be consistently performing. And if for nothing else, just the physical asset itself not deteriorating. And so what's happening here is that professional investors, we're very, very clear about what is a capital expense improvement in terms of state of repairs when we're initially evaluating this piece of property versus what can be either deferred or considered as part of your operational expenses. And so these are the things that you would typically look at after the first 3 stages, because again, it also depends on your risk tolerance level, especially, and then some of the other factors, meaning how much money you have access to in the beginning, how resourceful you can be. Do you have a crew ready to do the renovations work that you actually need to do? There's so many different factors to take into consideration. And this is why while a lot of people are adapting the BRRRR process, it is not exactly the first thing that we look at. So it's priority number 4. And so moving forward, priority number 5 will be terms and conditions. Now, the talk that I'm going to be sharing on stage at the multifamily conference today has a lot to do with terms and conditions, simply because of the fact that, again, assuming that you are looking at a piece of property where potentially it's free and clear and you don't have a lot of resources right now, financially speaking, to really close on a deal. However, after a lot of due diligence that you have already done, you realize that this is a very, very viable opportunity, as long as you can buy yourself some time to make sure that the performance level is there a complete acquisition. So what am I saying here with all those words looping around? Back here is seller financing, vendor take back. However, it doesn't matter how big or how small the properties are these days. I always will encourage my students, whenever we are making an offer, you always want to make two offers. One is cash offer. And by cash, I don't mean 100% cash buy. What I simply mean is to the seller. A cash purchase is as long as they can close on time with you in the time frame that they want, and at closing, they get their entire agreed upon selling price from you. So you could be leveraging a mortgage, you could be leveraging private lending. It doesn't matter what the case is. Cash offer just simply means that to the seller, they are getting all of their cash at closing. Now, an offer based on terms and conditions would likely be some sort of creative financing deal, meaning seller financing or vendor take back included. And so always make two offers. One is cash offer, the other one is based on terms. So this is probably why some of you, if you have been actually studying a little bit about real estate investing, maybe it's through other channels as well, or other courses that you might have potentially taken. And then one day you're driving around town, and then you see lawn signs and it says, "We buy houses, cash or terms." That's typically what this means. And so I want to make sure that you understand this. And the reason why it is not a top 3 priority and it's number 5, it doesn't mean that it's not important. To be completely frank, if I have it my way, every single item here would be 1 1 1 1 1 1 1. So it isn't really about which one comes first. However, it really has a lot to do with your experience level, your knowledge level, and the amount of support that you have when you are acquiring your potentially performing asset. What I mean by that is, well, this is why I use the word potential, simply because of the fact that maybe it won't be for a little bit, okay? And that's why I'm pretty sure I'm going to be sharing that same talk that I'm doing on the big stage today at the multifamily conference on one of the Daily Dose episodes. It's definitely not your newbie strategy, especially when you got to navigate through a lot of different regulations and lending rules, what can be done, what should not be done, and kind of figuring out the legal gray area for yourself. And at the same time, making the seller happy, creating that win-win situation that we always talk about. And so last but not least, when it comes to top priorities, is appreciation. And so again, educated and professional investors are performance-based investors. Appreciation is great. At the same time, it's not something that we count on. However, what we do count on is what we call forced appreciation. Forced appreciation. Now, forced appreciation typically is created after the value add stage in your BRRRR process. So after renovations, you typically should be able to rent it and rent it at a better price, meaning that you have better gross revenue coming in. Ideally, that will elevate your overall net operating income at that point so that it is performing better. And so what that means is, in a single family home situation, that is directly compared to a recent sold comparables. And so you can see how much equity lift that you've gained. Or in a larger multifamily commercial type of deal, you can strictly look at the net operating income based and then measure it against the lender's cap rate or capitalization rate, which again, I've already discussed in previous seasons. If you want to go back there and get some understanding there, that'll be great. I will continue to talk about these things and create different episodes to really dive in a little deeper. However, I know some of you have already told me that, oh my God, I've been going back to the previous seasons and watching the other episodes, and now the dots are connecting a lot faster. That's great if you're doing that. Some of you are basically following along for season 3, and that's totally cool too. So that is forced appreciation, because once again, single family homes, it's based on comps, and multis and commercials, you can base it on net operating income measured against lender cap rates or the market cap rates. And then that way you can actually determine how much forced appreciation is actually being created. And obviously, the last little note that I always have here is that appreciation for a lot of amateurs, what they think about is the natural market appreciation. That is not appreciation that we even calculate nor bank on. And that's why, especially when it comes to long-term buy and hold in terms of income properties, we talk about the fact that it is about cash on cash. And I already discussed this in the previous episode in terms of what the main difference is between return on investment as well as cash on cash. Or some of you may have heard the term cash, not just cash on cash return, it's return on capital. If that helps you remember the different terms, even though they are also very similar in their own ways. And so appreciation is fool's gold. If it's there at the end of the day, great. However, is it something that we bank on? No. And so I want to make sure that even at point 6 here as a top priority, I want you to really be clear about forced appreciation versus natural market appreciations. And I'm hoping that the volume's coming through great. I know there's probably quite a few sounds going on. People are setting up their booth now. And hopefully this has been an episode that has really lined up some priorities. And I know a lot of you guys are constantly giving me feedback and questions. So with that said, I really just want to show you my gratitude and my appreciation to let you know that I love the interactions that I'm having with you guys, especially on an international scale. Now, I've been very blessed to be doing this. And this weekend, I'm super excited to be at a larger conference again, being able to sit on a big stage in front of nearly 3,000 people to share my journey, my experience, and some of the knowledge that I have learned and gained along the way too. And this is really what the Daily Dose episodes are about as well. So if you're not able to make it to this conference this weekend, I thank you for sticking with me and continuing to support my Daily Dose with Tim. A lot of your questions, I am noting them down and I will be addressing them as we go along the season. All right. So with that said, have a great rest of the day. I know to my American friends, it's a long weekend for you as well. It's not a long weekend for me, which means I will be back here on Monday regardless, even if it is in Canada. So have a great rest of the day. Enjoy your weekend. And if you're at the Multifamily Conference right here in downtown Toronto, come by the Treasure Talent Academy booth and say hi. And I will bid you adieu and have a great rest of the day. Live well, everybody.